Good afternoon, traders and investors. Will back here with another one, coming to you with a Wednesday market update. Hope everybody is doing well. So in today's markets, guys, little bit of a mixed session indeed. SPY and QQQ ending red. Most of your losses were coming in from technology, more specifically semiconductors, pulling back more than the rest. On other news on the day, we got some very spicy headlines, guys. Number one, US House passes a bill that could ban TikTok nationwide. So we're going to be covering that headline today. We also have another headline from Tesla this time. Tesla getting another downgrade, adding to its negative news headlines over the past 2 months. Seems as though the company just can't catch a break. Elon Musk's Tesla is now a growth company with no growth. Wells Fargo writes in scathing downgrade. That was a very bad news report for Tesla on the day. And in third, we get some more news from dollar stores here. Dollar Tree, one of the companies that we've been closely following to see if they can have a turnaround story. Usually dollar stores representing a decent trade, especially in a high inflation environment when consumers are pinched in terms of how much money they can spend on items. You would expect them to all go to dollar stores in favor of shopping at normal grocery stores or larger retailers just to save some money. However, that trade has not been doing very good over the past year, and the downfall just continues, guys. Dollar Tree down 14% after their earnings. Dollar Tree's 1,000 store closure, which they just announced today, tells the perils of poor acquisitions. So we're going to be covering those company earnings, guys. In today's video, we're going to be going over that TikTok headline and what could potentially be the implications for a TikTok ban, and more specifically in relation to big tech companies that operate in China. Will China be able to retaliate if ever TikTok gets banned? And keep in mind, we have a lot of large brand names, American brand names in China, the likes of Apple, Microsoft, and others. So going to be very curious to follow this story as it moves on. Second, we're going to cover the earnings from Dollar Tree, of course. They were the most notable mover on the day, so I will cover them. A little bit limited on time tonight here, guys. Did want to cover either Lennar or SentinelOne, but we'll have to do them at a later time. I'm only going to be doing Dollar Tree today. Tomorrow, we're going to take a look at Dollar General and Adobe most notably. And then on Friday, we'll probably do Ulta Beauty and one of the two, SentinelOne or Lennar. So that's just a quick little earnings recap here. And then obviously, guys, we're going to do our major index rundown in terms of our technical analysis here on a technical analysis on major indexes. And lastly, wrap it up with our major tech names. So that Tesla news will be coming in when we do our major tech name recap under the Tesla section. And keep in mind, guys, if ever you want to go to a specific portion of the video, I always link the timestamps down below if ever you want to go to a specific portion of a video for a specific topic or stock. So with all that being said, guys, let's get right into today's headlines. So SPY and QQQ down, decent rotation from financials. Let's take a look at the heat map here, guys. And you can see on the day, largely led down by big tech. Now, Google and Amazon having some green, but Meta, Apple, Microsoft, Oracle, Adobe even down, and semiconductors really pulling back hard. Now, we did have some decent rotation in financials, mostly helping keeping the market from selling off too much, but even some rotation to the downside in healthcare. The bottom half of the market was relatively healthy. However, you do see some fair rotation across the board, but as a whole, guys, it was fairly mixed as a session. On the one-day relative, you can see that even better, basic materials and energy outperforming everybody by a large margin, and to the downside, technology, real estate, which was really hit bad after yesterday's CPI report, potentially leading to higher rates for longer. And then healthcare also rotating to the downside, but that is perfectly fine, guys. Healthcare has had a heck of a rally so far, so a little bit of downside for healthcare is nothing to be alarmed at just yet. So before we get into our earnings play for Dollar Tree, let's take a look at the TikTok headline here, guys. So US House passes a bill that could ban TikTok nationwide. This is very, very important, guys. So take a look at this. The U.S. House of Representatives has passed a landmark bill that could see TikTok banned in America. It would give the social media giant's Chinese parent company, ByteDance, 6 months to sell its controlling stake, or the app will be blocked in the U.S. They want to push ByteDance essentially to sell its TikTok arm to potentially a U.S. or American company specifically. That is what they want. While the bill passed overwhelmingly in a bipartisan vote, it still needs to clear the Senate and be signed by the president to become law. However, Joe Biden has spoken on this before, guys, and he said that if this bill were to be presented on his desk, he would indeed sign it. So really only the Senate currently is standing in the way. But with such a overwhelming support that we just got here, guys, from Congress, pretty much, it won't take much to pass it through the Senate as well. We could really be looking at a TikTok ban. Now, lawmakers have long held concerns about China's influence over TikTok. TikTok is owned by a Chinese company, ByteDance, which is subject to a national security law requiring it to share data with Chinese officials. This is well known here, guys, right? And it's kind of unfair. I understand why they're pushing to ban TikTok. Keep in mind, guys, in China, platforms like YouTube, or Google search, or even Facebook are banned for Chinese nationals. You just can't use them in the country. So the US is coming back and saying, well, if you guys aren't allowed to use our social media platforms, maybe we shouldn't be allowed to use yours. So that is pretty much the ongoing developments, guys. Until this is actually passed and signed by the president, it is not official yet, but we need to be keeping a very close watch on what happens with this. Because if one thing's for sure, guys, China can and most probably will retaliate in terms of potential levies or sanctions that they may put on American companies that operate currently in China. Think of large names such as Nike or Starbucks or Apple or Microsoft and companies of the likes, right? So we really can't get into a technology war with China at this point, guys. It really would be bad for the worldwide economy as a whole. So that's why we need to follow these developments extremely, extremely closely. And as more and more developments come underway, we're going to keep an eye on this story. And I'm probably going to do a deep dive at a later time. Since this is brand new, I want to do a bit of a deep dive as to how much of your large tech sales could be impacted if China potentially puts restrictions on companies such as Apple or Adobe and other big tech names as a rebuttal basically against this ban. So very, very big story that we have to monitor closely, because a lot of our big tech name companies can be affected if this does happen. So now that that's taken out of the way, guys, let us cover our dollar tree and see what exactly happened with this company here, guys. So as I was saying, dollar stores, I mean, it seems like a no-brainer trade for the most part, right? When consumers have less money, you would think that they would stop shopping potentially at Walmart or Target and go even lower in terms of price savings and start shopping at Dollar General or Dollar Tree. But if you take a look at these stocks, guys, I mean, they've been relatively either flat or notably down in the case of Dollar General over the course of the past year. And it's just been a question that these companies keep reiterating, that although they have noted an influx of new customers, that most of those new customers are not interested in spending money on discretionary items such as toys or kitchenware, stuff like that. They're more concerned with only buying the essentials in terms of either soap or other products just like that, right? Really products that you need, and not just spending extra dollars here and there on non-discretionary items that you don't need, right? So these companies have had a large problem with discretionary spending, but also they've had a very large problem with theft. And theft has been a major issue over the past year and a half, not only for the dollar stores, but for a lot of retailers combined, guys. Think of Walgreens. Walgreens has been plagued by theft here over the past year and a half, and it's really hurt that company's earnings. Dollar Tree, Dollar General are in that same boat, and even other companies such as Walmart and Target have touched upon elevated theft over the last couple of quarters in their earnings calls. So this is really playing a big portion for these companies' ability to drive profits to the bottom line. It's really eroding their profit margins. So for this company specifically, guys, take a look at what happened on earnings. They came out first thing this morning. They actually had a miss on earnings, on EPS by about 4.3%, heck of a miss to the downside. And then you also had a notable miss on revenue, and the guidance for this year was not that fantastic either. Going to be another transition year for the company. So the company now down about 14%. And I actually had an earnings play on Dollar Tree myself. I had written the 131 puts leading into this morning from yesterday. And the expected move on the stock was roughly about 6.5%. And I really went with double that, going almost 12.5% to the downside. Still was not enough. And when I read the earnings report, when I read how many stores they were closing and how big this transition period is going to be for them, even though we're relatively close to my strike price, guys, I just closed the trade at a loss. Just do not have high conviction in this company's ability to turn around its business within the next 1 to 3 months. It will be a longer story, most likely taking 6 to 12 months. And that's what the company said on their earnings call, guys. They really do not expect good things before the second half of 2024. So personally, I am just not willing to wait that long and stay in this trade for that long, even though the valuation can be argued to be relatively cheap. They still have revenue growth through 2027, about 5%, EPS growth through 2027 of about 15%. That's not really the problem. The problem comes that it all comes, guys, in the later part of this year. So EPS expansion over the next couple of years is decent. Revenue expansion is decent over the next couple of years. So as a longer term investment, there probably is a trade here. But as a short term swing trade, I would not be surprised if the company continues its downtrend here, continues selling off, potentially back into the lower 120 area, which is your previous big resistance, which should now be new support area, as they just balance with this transition period. So would not be surprised. Not the best opportunity for a swing trade just yet, but in terms of a long-term investment, I mean, the value is pretty much there currently. PE for 2024 ending at $128, which is their current share price, is about 18, and their PEG ratio at $128 is about a 1.2. Not that bad as a whole, guys, but as I said, the transition period for this turnaround is going to be a lengthy process, and I just don't believe that now is the time. I do believe that we can even wait a couple of months before giving this trade an opportunity. That being said, we obviously have Dollar General that's going to report earnings before the open tomorrow, so we will see if they are basically saying the same thing as Dollar Tree. Now let's get in to some of the Dollar Tree headlines that happened over the earnings, and then we're going to go through their earnings directly and see a bit in terms of their financial statements and as to how the company foresees the next 6 to 12 months. But really, guys, it is not good. So in terms of the headlines here, Dollar Tree 1,000 store closure tells the perils of poor acquisition. So we're going to go over that, what indeed that acquisition was. The dollar store chain announced on Wednesday it plans to close 600 Family Dollar stores in the first half of 2024. It'll shutter another 370 Family Dollar and 30 Dollar Tree locations once their current leases expire, bringing the total closure to 1,000 stores. That is absolutely massive, guys. They only have about 15,000, 16,000 stores currently, so that's a decent proportion of them. We believe rationalizing these unprofitable locations will help unlock meaningful value at the enterprise level, said the CEO. He added that the company could lose $730 million in annual sales. Now, the company does bring in about $31 billion in annual revenue, so this only represents about a 2.5% decline in sales. Still notable due to the store closures, but boost its earnings by 30 cents on EPS with cost savings. So it's really doing a case of cutting off the arm to save the body. That's exactly what Dollar Tree is doing right now. So once again, a little bit of a transition period for them. Take a look at Dollar Tree's overall locations over time here. You can see that their current store locations stand just under 17,000. Most of these were acquired after an acquisition that they did of the Family Dollar brand for about $9 billion back in 2015. That's why you see a net increase in store locations here. It's just basically the merger of two large companies at the time, Family Dollar and Dollar Tree winning the bid over Dollar General to buy Family Dollar back in 2015, but it has not proved to be a very good acquisition, and we'll get into the numbers as to why. The latest development is the culmination of nearly a decade-long struggle for the discount retailer to integrate Family Dollar into its portfolio. Dollar Tree fought hard to win the chain, competing with Dollar General, which offered $9.7 billion for Family Dollar in 2014. So they actually beat them out for a lower price. We're not going to get into that, but just so you guys know, guys, it's all about the brand image right now. However, its newest prize was a suboptimal business in need of a turnaround with a weak brand image and quite weak brand loyalty. Very harsh words for the company, right? They've rebranded some of the Family Dollar stores to Dollar Tree, done a bit of work on private label. They've tried to shop different price points All of these things are sensible, but they're sort of drops in the ocean. They're sort of papering over the cracks, said one analyst here today. The closures are a tell that for the first time, the company is recognizing that its Family Dollar business isn't working. Dollar General, which is set to report its Q4 earnings tomorrow, is likely thanking its lucky stars that it didn't win the bid for Family Dollar. So, very negative connotation to that article, right? Well, let's go over the exact numbers on Dollar Tree and see, is the article negative for a specific reason? And the answer, guys, is indeed yes. So here we have some statistics, guys. Same store net sales, Dollar Tree up 6.3%. So that brand is doing good. But the other half of their business, because they're in terms of the store count, it's roughly half Family Dollar and half Dollar Tree. Look at Family Dollar, guys. Same store net sales down 1.2%. That is not good at all. Comparable transaction count, Dollar Tree is up 7.1%. So not only do you have net new same-store sales, you also have more transactions for Dollar Tree, 7.1%. Look at Family Dollar, guys, 0.7%. This is literally half of their entire business showing no or declining growth. That is terrible. Results include a $595 million charge for portfolio optimization review, a $1.07 billion goodwill impairment charge, and $950 million trade name intangible asset impairment charge. This whole paragraph is a fancy way of saying we really screwed up in buying Family Dollar, and now we're having to write down those lines on the balance sheet because it's not a profitable business. So we are writing off our acquisition at a loss. $2.5 billion in loss write-offs for the company, which gave them negative net income for this most recent quarter. Not a good thing at all. Now, the fiscal 2024 net sales outlook range of $31 billion to $32 billion, that's actually roughly in line. Little bit below guidance, but roughly in line for net sales for 2024, so decent. And then fiscal 2024 diluted EPS outlook of 6.7 to 7.3. The analyst expectations are about $7, $7.05 in earning, so that's really right in the midpoint. So at least in terms of the total guidance for the year, it's not that bad. However, the first half, while they're doing all of these write-offs and all of these store closures, is not going to be an easy period for the company. That's why I say, in my opinion, the trade can wait. Now let's look at some additional business highlights before we get into the financial statements. Net cash provided by operating activities increased $1.07 billion in fiscal year 2023. That's somewhat decent. Other than the write-offs that they had to do, they actually improved their net cash by operating activities. That is largely, guys, and I say largely, I mean 90% plus due to Dollar Tree. Family Dollar just not performing at all, losing them money as a whole. And they increased free cash flow by about $200 million compared to fiscal year 2022. That's okay. Now, in terms of your yearly results, guys, take a look at this. Dollar Tree same-store sales increased 5.8% on the year, driven by a 7.4% increase in traffic. That's what we saw earlier, partially offset by a 1.5% decline in average ticket. So even though they have an increase in traffic, the average ticket, so the average bill that the customer walks out of the store with after they're done purchasing, is actually down. So there's more consumers, but every consumer is buying less things, essentially. Now, Family Dollar, on the other hand, 3.2% same-store net sales increase for the year was comprised of a 2.5% increase in traffic, along with a 0.7% increase in average ticket. So that's a little bit of a misleading headline, right? Even though the fact that they're up in same-store sales, their ticket price is also up. Their average traffic is also up. That is largely because of the first half of 2023, guys. The second half of 2023, when inflation really started hitting people harder, all of their numbers were negative, but at least on the year's average, Family Dollar is okay. But for 2024, guys, the Family Dollar brand is really going to have a heck of a rebrand. Now, the decline in gross margin was driven by elevated shrink. So obviously they have a decline in net margins for all the reasons we just described. Business is performing poorly. The decline in gross margin was driven by elevated shrink. Shrink is a fancy word for theft. So elevated theft, product cost inflation, unfavorable sales mix. Unfavorable sales mix just means that consumers are favoring the lower margin non-discretionary items, right? Such as soap and other things that you need for a household on a weekly basis, as opposed to consumers buying their higher margin products. So let's say like on toys, the company may make 10%, 15% net margins when you buy a toy for $5, right? But on a bottle of soap that they already, let's say dish soap or whatnot, that they already sell for cutthroat low prices, they maybe only make 2% net margins on those, 3% at best. And the consumers are flocking towards those essential items, but the essential items, guys, they have low margins, and the consumers are not buying those non-discretionary items that have higher margins of about 10 to 15%. So that is pretty much a reason, also one of the reasons why they were down. Now, a little bit of a positive headline right here. While share repurchases are not included in the outlook, the company has $1.35 billion remaining under its share repurchase authorization for 2024. So at least they can still do a few share buybacks here, guys. And $1.35 billion, it might sound like a low amount, but in terms of the company's market cap, guys, 1.35 divided by 28 billion market cap, that's still about 5% of shares outstanding. So at least you have the company willing to buy back 5% of its shares, right, at these lower price points, which is relatively good for the company. Now, let's take a look at some of their financial statements, guys, and you'll see they're just not very good. So take a look at total revenue, guys. Total revenue year over year increases right here. Revenue up about 8%. But take a look at the cost of sales. Cost of sales, guys, far exceeding the revenue. Cost of sales up 9.6%. And I'm not even including the costs of those goodwill impairments. So the write-downs of the unprofitable portion of their business, Family Dollar, not even including those. We're only going to go off of cost of goods sold, because when you get into the rest, it's a little bit of an accounting nightmare to pretty much reconcile these one-time lined items with the rest of their financial statements. So we're going to keep it very, very simple, guys. Just look at their cost of goods sold, okay? That is above their revenue growth. So they do not have operating leverage in the basic cost of goods sold increasing higher than their total revenue. Not a good sign. And then when you obviously look at your selling generative and selling general, so your SG&A expenses, right? Selling general and administrative, don't know why that was so hard. But those, because of the one-time line items, they are up significantly on a year-over-year basis. But we're going to give the company a chance, guys. Right, we're just going to give them, we're just going to measure operating leverage based off of net sales versus cost of sales, which is just not good. So the company doesn't have operating leverage. Its expenses are far outpacing its revenue growth. That is a problem for the company. Now let's take a look, guys, at their total gross profit. You can see total gross profit was affected most recent year. Total gross profit 30.4%, down from a previous high of 31.5%. So decline in gross margins. And take a look at your operating income margins for Dollar Tree versus Family Dollar. Dollar Tree, not too bad, 13.6%. That is standard relative to what it's done in the past and standard relative to its competition like Dollar General. Those are decent operating margins. Family Dollar, however, 20%, guys, 19.3% operating loss. Now, a lot of this is due to one-time lined items, but if you were even to remove those those one-lined items that they're writing down the portions of the business, guys, they're still negative by about 4%. It's just not good enough. They have to do some heavy rebranding of the Family Dollar brand as a whole. Take a look at their balance sheet, guys. The balance sheet is not fantastic either. Cash and cash equivalents, only $685 million. Take a look at total long-term debt. Total long-term debt, guys, is almost $9 billion. They only have $700 million in cash and cash equivalents and $9 billion in debt. So the balance sheet is not the best, considering the fact that it's not a high margin business to begin with, right? The company doesn't generate a ton of free cash flow on a quarterly basis. If I take myself out of the way, you'll see that quarter over quarter, they really only bring in, $200 million in net income, and they can't obviously use all of that to pay down their debt. They also have to do some share buybacks and whatnot. So just not a great position to see a company with so much debt and such razor thin margins. It just begs the question, how are they going to pay down this debt quickly over the foreseeable future? The answer is they don't really have a way to, guys, unfortunately. So all that being said, guys, not very good. The last thing that I want to take a look at, as usual, is your stock-based compensation. And for a total year, guys, only, let's call it about $100 million round number. Not that big of a deal, guys. When you compare it with $30 billion in revenue, that's really not that bad at all. This is a one positive point for the company. And then again, they do buybacks. So actually, your net effect on shares is not going to be dilution. They're actually going to be buying back more than they pay in stock-based compensation. So at least they're burning net shares on a year-to-year basis. That is good. So all in all, guys, as I've been saying, just a quick recap, not the business for me right now. I would rather wait at a later portion in the year when I'm certain of management's plans and actions as to how they're going to turn around the family dollar brand. And as a trade as a whole, guys, you know, the discretionary spending trade has been terrible for so many different companies. Think about Starbucks, think about Nike, right? None of them have been doing good. And this one, unfortunately, guys, you know, as I was saying in the introduction of this company, it's just such a tough position to be in because you would usually assume that dollar stores would be doing good in times where consumers have a lower amount of money to spend on household items. But unfortunately, they have pivoted to dollar stores, but not for the right reasons. They're only buying essentials. And as we've covered, guys, the essential items at dollar stores, they're just not very high margins for the company. So everything is hurting. Yes, the company's making more revenue, but it's being hurt by lower margins and being hurt by its family dollar brand. So just not a very good trade for me, guys. I would really only get interested in this company again if we do trade back down 120 all the way down to 110, guys. I really want to buy this one as close as possible to $100. At that point, I'd be willing to give it a chance. The PEG ratio at that point would be under 1, so it would be a good buy. But as of now, guys, just too much company-specific uncertainty and kind of working in the opposite direction of macro as well. So really unfortunate for Dollar Tree in that aspect. Dollar Tree, even Dollar General not performing well. You guys know which dollar store has been absolutely killing it? The Canadian dollar stores, because we don't really have a problem with theft up here for some reason. I haven't analyzed as to why, we don't have as much theft pretty much as in the US. But our dollar store, Dollarama, the leading Canadian dollar store brand, has actually been doing fantastic through this inflationary cycle. So that's been one that's been heavily outperforming. But for some reason, the US dollar chains have just not been able to convert to this amount. And take a look at Dollarama, right? Our Canadian brand. Look at these net margins, right? How do you like these for net margins, right? 17% net margins not being affected, and they actually are the benefactor of the inflation trade. This company has seen record number of sales and record profits because of discretionary spending being low. Everybody's pivoting to dollar stores. Not too sure why that's not having the same effect as in the US, but such is that trade, right? So big discrepancy between the Canadian dollar store right here. And we really only have one, guys, to be honest with you. They're pretty much the leader in the entire market. There really is no other second close competitor to Dollarama right here. Just unfortunate to see that Dollar General, look at Dollar General's margins, 6% of 2022. If you took a look at quarterly basis, shrinking margins, 4, 3, 2%. And Dollar Tree, we just went over, same thing, guys. So if anything, the outperformer is the Canadian dollar chain if you're interested in any dollar store plays. Now, guys, let's move in directly to our technical analysis on our major indexes, and you will see that not much has changed, still maintaining this daily uptrend on SPY for the bulls. So the next target we're going to be looking at here, guys, for this daily uptrend is going to be the top of the trend line, talking roughly $525 to the upside. And the downside, guys, still maintains. Keep in mind, Jerome Powell next Wednesday is going to be absolutely huge. And if you ask me for my gut feeling, guys, especially in relation with all the hot inflation data that we got in January and in February with the most recent one coming out yesterday, I do believe that Jerome Powell is just going to keep the same stance as he's been having, basically being data dependent and seeing no real rush to bring interest rates down. And I do believe that when the markets finally hear that in March, you may get a little bit of rotation here coming into the markets, potentially to the downside. Now, keep in mind, we also have the summary of economic projections, aka the dot plot coming out. And the one from December was relatively bullish. At that point, we were maybe forecasting 5, 6, 7 rate cuts for this year. But when this one in March comes out and probably shows that there's only going to be 2, 3, 4 rate cuts, it'll finally give the market the confirmation that the Fed may just not bring rates down at all until maybe June or even July, and then maybe only cut 2 times after that. And maybe at that point, reality will set in to the markets and we may be ending up for some consolidation. So I'm going to be keeping a super close watch on who is in control of the daily time frame leading into next Wednesday's meeting. Crucial. That being said, your daily higher low is right here. The whole reason I said that, guys, we keep an eye on this higher low right here, 509. If we break 509 before the FOMC and come dangerously close to the lower of the trend line, and then Jerome Powell comes out as a hawk and crushes us and lose the trend line, guys, that's going to be your extended weekly consolidation. So that's just one of the negative scenarios that I'm potentially starting to analyze right now. But all focus, guys, is on who controls this daily trend. And so far, so good. It is still the bulls. Keep a very close level on 509.40. If we lose that, bears gain control of the daily downtrend. And by next Wednesday, guys, keep an eye how close we are to the bottom end of this trend line. If by next Wednesday, guys, we're all the way up here, then it's fine. We have a decent amount of space to work with, even if Jerome Powell crushes us. But if we come into the Fed Wednesday, all the way down here, guys, a crush could just ruin this whole trend line, send us into extended weekly consolidation. And at that point, guys, it'll take at least a few weeks probably to recover back on schedule for the market bulls. Now moving on to QQQ, same analysis as SPY, still keeping an eye on who is in control of this daily trend. You can see we've pretty much been range bound now pretty much since February, so almost a month at this point in terms of range bound on QQQ, still within our trend line. We're going to keep an eye on these lows right here, absolutely crucial, the 435 area. Whoever controls this daily uptrend leading into next Wednesday, same analysis as SPY. If we're all the way up here next Wednesday, then we have enough space, guys, to at least fall back into our trend line and maintain. However, guys, if we either are close to this or below this coming into next Wednesday, the downtrending scenarios could be quite noteworthy, right? So we're going to keep a close eye on this low right here. 434 is going to be essential for the bulls to protect, rather. That being said, we're in a tightening range, so still looking for a break of the bottom side, which we just reiterated, 434. Break to the upside, 448.65 would just confirm the continuation of the daily uptrend. So far, no red flags. So far, we are still in a nice weekly uptrend right now with some sideways weekly consolidation. Would like to see us push into the higher portion of the trend line, give ourselves as much space as possible before Jerome Powell can potentially crush us, right? Now moving on to XLF financials and to the upside, guys, obviously I'm not really giving upside targets here because the purpose of the game is risk management, right? We know that if the markets just go up, well, there's nothing to worry about. We're worried about pricing in the risk of a multi-week decline following Jerome Powell's statements and where we could potentially end up after that and the trades that we're looking to make after that, specifically into big tech. So that is going to be on the watch for the next week. Now moving into financials. Financials really outperforming on the day here, guys. 0.73% to the upside. Extremely bullish for financials right now. The daily uptrend simply continues at this point. It is gorgeous. Any pullback just going to be for a daily higher low, anything above 40.4. Daily higher low for further trend continuation. And where are we going with this beautiful trend continuation? We are going right into the all-time high areas, talking roughly about 41.5 is your next all-time high area of resistance. So monitor that one closely. Could possibly be getting rejected there and then setting the daily higher low before making a second stab at it. But one thing's for sure, financials have really been outperforming on the year-to-date, guys. Take a look at year-to-date performance by a lot of your financials names, right? Visa, MasterCard up about 10%, JP Morgan 12.5%, American Express 19%, doing very good. Even some of your other banks, right? Wells Fargo 17, very, very decent returns from your financials right here. So very, very good for them. Obviously nothing compared to your semiconductors, but still most of your banks are outperforming Apple. So that says something, and healthcare as well with some beautiful rotation. So moving on to the healthcare sector specifically now. So healthcare, you will see that yes, we're down 0.39% on the day, but we are still within the range of this healthy little uptrend right here. So what we were looking for after yesterday's daily trend breakout, we were looking for any signs of pullback to be a higher low, anything above 145.33, just for a daily higher low for further trend continuation. One thing that I like to see over the course of the day today is how well the bulls defended this 12 EMA. This 12 EMA is extremely, extremely good, or has been extremely good rather, for the bulls over the course of the rally in the past 4 months. Now, that being said, if we for some reason lose the 12 EMA shortly moving forward, we will just be heading into further weekly consolidation. And as you can see, guys, healthcare has been relatively flat for the last 3 weeks. That's why we've had some weekly consolidation, mostly sideways. And what I like to see, guys, is the sideways consolidation to happen at the top end of a move. Whenever we get sideways consolidation at the top end of a very nice weekly move like that, it just screams weekly bull flag into potential further upside continuation. That being said, if ever, for some reason, the markets fall apart even into next Wednesday and we end up with a daily downtrend, there is tons of space for the bulls to set a weekly higher low. And the likely area for me is going to be a retest of your previous all-time highs, the 142 level. And look at that, your 12 EMA on the weekly is also right in that juicy point as well. So if we do get any pullback in healthcare, so far, no red flags. But if we do, on a more extended basis, 142 is likely going to be the mark. Now moving on to Russell. Russell, 0.39% to the upside. Noteworthy because SPY and QQQ were red today, so nice to see a little bit of outperformance in growth stocks. Nothing notable, however, we are still dangerously close to our lows. So yes, we're in a daily uptrend right now. But after yesterday's video, we were saying how we were getting nervous that the bears took back so much of this most recent upswing. Usually when you see that, it could set up for lower high into lower low. That would be daily downtrend, and that would be further weekly consolidation. It would be extremely healthy, however, because if we do end up in weekly consolidation, it'll just be a weekly breakout, retest of this big previous support zone, which was previous resistance. It's now going to be acting as support, right? A year and a half's worth of resistance. So I really want to focus on that, guys. When we pull, but if we pull back into this area, I am looking to potentially acquire some Russell shares, most likely in the form of the 3x leveraged TNA play, which I will be holding as a swing trade, most likely for the remainder of 2024, because I do believe that the Russell is poised to really start ramping up when that risk on trade becomes more prevalent after potentially your first rate decrease in June and some more optimism coming out of the Fed once rates will start finally coming down. So that being said, Russell still looking very decent. Keep a close watch on yesterday's low, guys, 203.60. Flush that to the downside, daily downtrend confirmed, and then we look for a potential weekly buying opportunity. 195 would be the ideal location that I'm personally looking for. And now lastly, the Dow Jones. Dow Jones acting quite nice today, guys. 0.10%, relatively flat day, but one thing's for sure, we have now recaptured the daily uptrend. That is what we wanted to see. The bulls protect that. So daily uptrend started anew, and now we're looking for any time we get a pullback here, guys, needs to be a daily higher low and higher high for further trend continuation. Anything pretty much above 38,500, let's call it, just going to be higher low for further trend continuation. We are above this yellow line right here, which is big previous resistance, now back above that line of support, and we're back above our crucial moving averages. Take a look, guys. You need to hold the 12 EMA, this yellow line right here, for the bulls to be healthy, and they've just recaptured that. So as a whole, weekly uptrend also still looking good. Just a little bit of sideways consolidation could be interpreted as a weekly bull flag for further continuation to the upside. Dow Jones looking very good, if I do say so myself. Now let's move into some big tech names, shall we? So first, going to move into Apple. Give me a quick second. So moving into Apple, guys, 1.21% to the downside, and Apple still struggling. And today, as a matter of fact, we have now lost the hourly uptrend, right? Big hourly trend reversal here. So at that point, guys, you could assume that your daily push higher is finished. And as we've said in yesterday's video and videos prior, we have been in a daily downtrend on Apple now since the end of January. So very negative daily downtrend for Apple right now. We were looking for the size of this bounce to provide clues as to whether or not the bulls would create enough space to maybe on a dip, set a daily higher low, and then reverse into a first daily uptrend that we haven't really had, guys, since last December, right? So that's what we were looking for. Unfortunately, as I was saying in yesterday's video, the bounce wasn't high enough. We only bounced 38.2%, which is not enough. You needed to get at least 50% or at best 618% above on the fibs here to give the bulls the best shot at creating enough space to then, when they retrace, set the daily higher low and get the daily trend change. As of now, with the size of this bounce, considering that we just now lost the hourly trend again, if this does continue into tomorrow and we get further downside, the bulls have to protect these lows, 168.50, with their lives. If we can potentially set a double bottom and then bounce, that would be best case scenario. However, that's not what the probabilities favor. Remember this fib right here? If we only get a 38.2 bounce, usually the probabilities do favor the bears, for follow through to the downside. So if you do get follow through to the downside, guys, it'll be all up to these last remaining support levels right here, talking about 166, 155. because after that, we're really heading down to our next area of congestion, which is about 155 between 155 and 150 pretty much. I'll draw those if we do come to them. So we're now looking out, can the bulls save these lows? Or at worst, can we save the lower lows right here around 166? One thing is for sure, Apple's valuation right now is a lot better than it was when it was trading at the all-time highs. I am still interested in this trade in this area. 180 down to 165 pretty much is a very, very sweet spot for Apple. Previous big resistance, and current nice area of support. Keep in mind, Apple already from their all-time highs down anywhere between 14 and 15%. So a very good discount for Apple shares, guys. That's usually how much you get when Apple tends to go through one of these declining cycles right here. 15, 20% in a bull market, an overall bull market, is usually the size of the drops that you get with Apple, not much more. So I'm very looking forward to the eventual turnaround of the company. That being said, as long as it keeps trading in these lower levels, guys, I will keep playing the stock aggressively for that eventual longer form recovery, right? That in mind, daily downtrend to the bears and also weekly downtrend as well. So as soon as we get an official daily downtrend, then we'll be measuring the size of the weekly bounce. But for now, no daily downtrend yet. That is up to the bears, up to the bulls to prove to us that they can hold these lows, crack to higher highs. Then you'll have your first daily uptrend here, pretty much since back in January right here when they pulled off the double bottom, right? Weak bounce into double bottom and run. That's what we want to see here. Weak bounce into double bottom and run, best case scenario for the bulls. Now moving on to AMD. So AMD pulling back 4% on the day, but at least AMD has the space to do it. So now we've lost the daily uptrend, losing lows right here at $200, setting lower lows in motion, which means that weekly consolidation is underway. Now, upon weekly consolidation, I was saying in the prior videos, weekly uptrend is gorgeous. If we do pull back, guys, target the top end of this range, this big previous range that AMD was stuck in for pretty much over a month at that point, right? Top end of that is going to be about 182. So I do expect the bulls to be putting up quite a fight at 182 if we get down to there. And that'll just be for weekly consolidation. The size of this move down leads me to believe that if we do get a little bit of a bounce, it may just be for lower high, lower low continuation. And once again, that would just be further weekly consolidation. May just get a few more weeks of AMD consolidation here coming into the 180, 182 level. So that's what I'll be looking out on for AMD for some potential pullback. And I may even be tempted if we get into the 180 range, may even be looking for some swing trades, guys, in the 170, 165 range for some short puts, all the while that the stock is consolidating in that area. So not looking bad, but it's definitely some healthy consolidation on AMD's part. Now moving on to Amazon. Amazon 0.66% to the upside. Amazon really struggling with this 177 level that we keep bringing up, right? It struggled with it a ton back in 2020 and 2021, only breaking out above it just for a few weeks at a time before pulling back and getting trapped again. Well, now you see we've been struggling in this rough area, 174 to 177, pretty much since after earnings, right? Just not able to get it done. We are still in a technical daily downtrend. I like the size of this bounce by the bulls, but if for ever which reason the rest of the markets fall apart into the next week, daily downtrend can continue. At that point, guys, the daily downtrend would just go into further weekly consolidation, and we'll be looking at these weekly lows right here, 166 to hold up. If for ever which reason they don't hold up, you'll lose your weekly uptrend right here. It won't be a weekly downtrend. Weekly downtrend would be lower high, lower low. But if for ever which reason we consolidate more than your most recent weekly low, the one area we're heading, guys, is probably the earnings gap fill, talking about the 160 level. So key level, 166 is your first line of defense. It is your weekly higher low. And beyond that, your second level that I would be targeting is the pre-earnings level right here, $160. One thing's for sure, guys, it is all for long-term bulls to be buying right now. Beautiful, gorgeous monthly uptrend, right? And still in a very nice weekly uptrend too. So if we do revisit some of those lower levels, I am definitely going to be picking up some Amazon. Now moving on to Google. Google not looking too bad, 0.82% on the day to the upside. And now Google bulls have done a engulfing move, right? Recapturing almost over 100%. This was the size of the bounce that I needed to see on Apple, right? I was looking for a big bounce on Apple, didn't get it. Google, however, very nice. Google has also been trapped in this relatively nasty downtrend here since the end of the month of January as well. Nice to see them finally engulf one of the most recent selling legs. It sets the bulls up very nicely, guys, to have the space to set a lower, higher low into potentially higher high, reverse this daily downtrend into a potential daily uptrend. That being said, we're still getting rejected here, guys. 141 down to 138. It was our previous big area of resistance. It acted as support for a few weeks, and now we are trying to pull up into it, but you see the bulls are having a hard time getting through this in one clean shot. So if ever we get rejected by this area, I am potentially expecting a retest 136, maybe 135 to the downside, set the daily higher low, and potentially move on for a daily uptrend shift. And that would also start really retracing a lot of this most recent weekly downtrend as well, and would also signify that your monthly higher low is set and we are looking to recapture. That all relies on the recapture of the daily uptrend for the bulls. Looking forward to it. If Google does have a little dip again into 136, 135, that's where I'm looking to play this stock for the eventual recapture of the daily uptrend. So 136, 135, my swing trade locations. Obviously, if for some reason the bears just engulf this to the downside, buy targets, guys, 132 all the way down to mid 120s. I will be aggressively playing Google the entire time. Represents a tremendous buying opportunity, not only for a swing trade, but long-term investment as well. Now moving into Meta. Meta also struggling a little bit on the day here today, down 0.84%. So Meta, could it just be a case if the rest of the market continues selling off in terms of technology rebalancing? Could we get the lower high into lower low? That would be notable to us, guys. Meta has not lost the daily downtrend since here in November. Daily downtrend there. Have not lost the daily uptrend since then. So if we do lose this, it'll be the first daily downtrend on Meta in 4 months, would be notable to us. And then we would be looking out for further weekly consolidation at this point. So keep a very close eye on that for Meta. As of now, still looking decent, above our 12 EMA still, and this previous resistance line, which is now acting as support, we're above that too. So can Meta have an opportunity to just recover this and reset the daily uptrend? Yes, but if for ever it's reason we set the daily downtrend, it has to be notable to you that at that point, this stock will be in weekly consolidation, and then we'll be looking out to levels such as 455 to act as our first big line of defense for the longer time frames here. So we'll take this one day at a time on Meta. Not looking too bad. Just keep a very close eye, guys. 477, huge line in the sand level, in my opinion. Now moving on to Microsoft. Microsoft not looking too bad, 0.04% to the downside. Relatively flat day. Still trying to break out here, guys, of our 416 higher end of this range. You see they tried it today and got rejected. So Microsoft now in a nice little daily uptrend. If for ever which reason we fail, could be heading back, little daily higher low, and then make a second attempt at that, right? We are trapped in this range, but it's nice to see that the bulls have a daily uptrend within this range. So it gives us the best chance of potentially wanting to crack this to the upside. If we do crack this to the upside, daily uptrend simply continues. Next area of resistance, 421, all-time highs. And then we would also recapture a weekly uptrend that we've kind of been stagnant in for a better part of the last 5-6 weeks at this point. So very, very big level coming up for Microsoft. If we can break and close above this 416, will be absolutely huge for the company. And if for ever which reason, guys, we fail, retest lower daily downtrend, well, at that point, guys, it'll just be further weekly consolidation on Microsoft. Weekly downtrend, if you lose the 398 lower bound right here, just for a bit of monthly consolidation. No long-term red flags for Microsoft whatsoever, even if that does happen. And you guys know me, guys. If we get down 385, 390, that's where I'm looking to swing trade Microsoft myself. Now moving on to Netflix. Netflix down about 0.27%. Not the best day for Netflix, but still relatively flat, right? Netflix still trapped in this relatively tight range that we've been trading in for the last 10 days at this point. So it all relies on this 12 EMA. Look how well we've defended this 12 EMA ever since pretty much your earnings. If ever we lose that, it will be daily downtrend confirmed, and we will just be in continued weekly consolidation. At that point, guys, I would be targeting the top end of this range right here. We're talking about 575, which was huge during 2020 and 2021. That is likely the breakout retest area. So if we do retest this area, could be a potential decent little zone to be making some swing trades. That being said, the bulls are still in control. So if we do get a break bullish to the upside, looking for a break of 623, break 623 to the upside, weekly uptrend simply continues. And at this point, guys, The next target, really, since we're above the 615 level-ish, roughly on a weekly basis, right? Still trading with it. If we break 623, well, the next target to the upside is all-time highs, 690 up to about $700. Looking decent on Netflix, guys. Nothing bad to say. My trade opportunity is the retest zone. If we retest this zone, may throw a few shares at it here for continuation, talking about as close as possible to 575 all the way up to all-time highs. Moving on to NVIDIA. NVIDIA consolidating a little bit today on the day today, 1.12%, but not as bad as it could have been, right? It was down at one point on the day, roughly about 3%, almost 3.5% at one point. Nice to see them only close 1.12% of the downside. And now NVIDIA is facing a little bit of challenges, right? So we were saying that we're in a very, very healthy daily uptrend. However, the bears have taken back a significant portion of the move. Take a look at how much the bears have taken back in this most recent move, 618. And you guys know, since I've been showing fibs for a while on the channel, right? 618 gives the bears an opportunity to set the lower high into lower low conversion. If ever that happens, guys, well, we're just heading into very healthy weekly consolidation for NVIDIA. And I wouldn't be surprised at that point if we retest some of our mid 700 levels. 750, 730 seems like that would be the sweet spot for me for consolidation. That would put us right at our pre-earnings level, which is your big previous resistance and should now be acting as support. That would be for weekly consolidation. And obviously, well, the bulls obviously do have a chance here, guys, at just V-shaping this and continuing the daily uptrend to all-time highs, as we have not lost the daily uptrend so far. So NVIDIA, a little bit of an in-between zone right now. I would pay special focus if we lose 844, guys. First daily downtrend on NVIDIA. Geez, since pretty much the month of November as well, right? So that will be notable to us. So keep a very close eye. If that happens, I do believe we are probably going to be testing these lower levels, 730, 750. Going to be for a long-term buy though, monthly, a little bit of monthly consolidation maybe into further gains, weekly consolidation as well into further gains for the rest of 2024. So NVIDIA, no red flags as of just yet. Now moving on to Tesla. So Tesla down 4.5% on the day here today, right? So take a look at this. Elon Musk's Tesla is now a growth company with no growth, writes Wells Fargo in a scathing downgrade. Wall Street's stance on Tesla worsened further on Wednesday as yet another analyst warned about risks to sales and said its strategy of cutting prices to boost demand was losing its effectiveness. The electric vehicle maker's growth in its core markets has moderated, Wells Fargo analyst said, as he downgraded the stock to the equivalent of a sell rating. Langen expects Tesla's sales volume to be flat this year and to fall into 2025. Elon Musk's company is a growth company with no growth. He highlighted that sales volume rose only 3% in the second half of 2023 from the first half, while prices fell 5%. Not very good at all, right? Now, sentiment deteriorated after the company in January said its growth will be notably lower this year, while other automakers, EV suppliers, and even rental car companies have sounded similarly cautious comments about the near-term demand for EVs. So this has been something we've been talking about for a while, guys. So I figured I should do a little bit of a quick recap of what are the elements. Why is Tesla dropping so much? Take a look here, guys. Tesla is now the worst performing company of the entire S&P 500 on a year-to-date basis. Here's your S&P 500 component year-to-date returns. You even see it on the heat map. Look, where are the bright red components? Humana, they got levied a tremendous lawsuit against them. They're only down 25%. Boeing literally had a door fall off an airplane mid-flight, and they're down 30%. Who is the worst company in the entire S&P 500? Tesla, 31.79% to the downside. The best company is obviously NVIDIA. You see tons of gains. And if we scroll all the way to the bottom, as of yesterday's close, Tesla was before last, but today, Boeing didn't change much. Tesla went down 4.5%. Tesla is now the worst company in the entire S&P 500. Let's take a look at why. So we have some short-term negative factors here, guys, okay? So let's take a look at some of the short-term negative factors, and then we're going to determine whether or not they hold weight and go over some technicals. So let me blow this a little bit up for you guys so it's a bit clearer. So short-term negatives, you have the Elon factor, right? There's a shareholder lawsuit going on right now surrounding his compensation package that was approved by the board of directors. Now that is coming under fire. We brought up an article about 2 weeks ago at this point that lawyers were seeking $6 billion in Tesla stock as compensation for this lawsuit against the company. This is still ongoing. Also, the amount of time that Elon spends on Twitter has been a very hot topic for shareholders recently, as he's been focusing more and more time on politics and free speech, which are obviously important, but he's the CEO of Tesla. They want him back at Tesla full time to be focusing on the company specifically, as the company is now struggling. That's normal. And number 3, Elon wants more voting shares to push the AI ramp. This came out late January, where he said he almost refused to push forward AI and robotics at Tesla unless he got more controlling shares of the company. And this obviously did not sit well with investors as well. Now, that's just for a few elements with Elon, right? Now, I'm sure a lot of shareholders are accustomed to Elon's antics here on Twitter in terms of the time he spends on politics and free speech. It's a very noble cause, but keep in mind he also has at this point, $540 billion company to run. And if Twitter continues failing as it is right now in terms of numbers and in terms of revenue, he will have to maybe sell more Tesla shares to potentially compensate for that loss on Twitter. So that's a big factor, guys, right? Now, second, the EV demand at Tesla, which is not a Tesla problem. We've went over this over the past couple of weeks. It's a worldwide problem, right? So number 1, slowing sales growth worldwide. All OEM manufacturers have said the same thing. Number 2, you have USA price cuts, which translates into lower margins. Tesla is not the same company, guys, as it was back in 2020 and 2021. It is not the same company as it was back here, unfortunately for Tesla shareholders, myself included. That being said, guys, the price cuts are real. They used to have 30% gross margins. Those margins now are down below 10% pretty much, or excuse me, net margins. Used to be around 30%, and now the net margins on Tesla, guys, are about 10%. And that net margin decline, I mean, you can see it over the course of the last few years, right? It peaked pretty much 2022, 2023, in a few quarters. They were peaking right around, in terms of vehicle gross margins as well, around 15%, net margins for vehicles. So that was relatively good, but they've since been coming down ever so slightly quarter after quarter after quarter, and it's just going to continue, guys. Very unfortunate. Number 3, China price wars, right? Competing with a lot of different companies in China, and they've been aggressively in a price war for a better part of the last 6 months with no signs of that ending. As a matter of fact, they literally just reduced the price of the Model Y about a week and a half ago in China as well. So that's another red flag. Number 4, the Red Sea shenanigans, right? So everything that's happening in the Middle East right now obviously has been taking a toll on shipping times, which has led to a 2-week Berlin factory shutdown that they've just now got through. I think they literally just opened the doors back to the factory yesterday or the day before. So they're back online, but they lost about 2 weeks, guys. And if ever there's more and more Red Sea elements that surface over the course of the next few months, it will be affecting that factory once again. And then number 5, no clear guidance from 2024. This is the first time in years that Tesla last quarter gave no guidance whatsoever for the foreseeable future. They just said that it was going to be worse than 2023. So that's not very good at all, right? Now, we do have some long-term positives, right? We can't only focus on the negatives. That's why I call them short-term negatives. The company as a whole, guys, is well positioned for the future if they can get through this downturning cycle. Now, number 1, if they solve FSD, guys, everybody knows it, robo-taxis, it's a multi-trillion-dollar business. If they solve FSD, the applications are huge, not only for cars, but also for the entire trucking industry, think trains as well. The opportunities are endless, right? Very big business for Tesla, multi-trillion-dollar business if they can solve it. That being said, still not solved. Number 2, they have the most extensive charging network worldwide. This is a fact, guys. Other OEMs pay Tesla to partner with them to use their charging network. So that is definitely a huge positive for the company. They are also one of the most advanced robotics divisions worldwide. Not only have they developed a brand new set of production robotics for their factories over the past 4 or 5 years in terms of production efficiency and the custom robotics that they've derived for their production, guys, but they also have their AI and supercomputer plays in Dojo and Optimus. So Dojo is the AI software that they built to pretty much, construct the FSD, analytics platform, whereby they review data that's provided in real time by the cars. And it's one of the most powerful supercomputers in the world. So you have to give that to them, guys. And most of that is used to power a very potent AI algorithm that cycles through all of the data that the FSD software software brings it, right? So very, very positive. And then the another positive portion of the robotics division is Optimus. Optimus is their the actual humanoid-like robot that they've been working on, right? And it looks very, very good. So they have an extremely advanced robotics division and AI division. You have to give them that. Arguably some of the world leaders in that aspect. They also have very good solar exposure long-term. Their panels and Tesla home batteries are known to be some of the best in the industry, but we know that because of interest rates being high and whatnot, that whole industry as a whole has been lagging. But when it does start to recapture some consumer demand, they should have very decent exposure to benefit from the long term from that. Another point is they are one of 3 worldwide positive free cash flow EV makers. No other car manufacturers in the world make money on any single EV they produce. There's only 3 companies that do: BYD, Li Auto, and Tesla. And Tesla is the only American company, let alone that, the only Western company that actually makes a single dollar of profit every time it sells an EV. So you have to give them that, guys, right? And they will be coming out with probably a sub $30,000 to $25,000 car in 2026. So that should be even better for them. But until that time, guys, still a little bit struggling here with demand, right? And they also have a very, very good degree of brand loyalty too. Usually people, most people, I'm not saying everyone, but usually they have a high degree of brand loyalty in terms of return customers. And when customers do buy one of their products, they tend to be quite happy with the product. Now, they also have some of the best engineers worldwide. Tesla has said this a number of times, guys. They pay some of the best salaries in the world to attract the best talent in the world. And Elon Musk has been hyper focused on this ever since building this company 15 years at this point to what it is right now. They've always went for the best talent. So they have some of the best talent in terms of engineers, not only physical engineers in terms of, mechanical engineering and whatnot, but also some of the best AI engineers and tech engineers in the world. So all of those long-term positive, guys, the company is built on a very strong basis. If it can get through these short-term negative aspects, I have no doubt in my mind that Tesla will return to its former glory days. But because of the cyclical nature of the business, guys, it doesn't happen instantaneously, right? When rates come down 0.25, 0.5%, let's say rates come down a full percent this year, right? I mean, auto loan percentages will still probably be 7-8%, which is unaffordable for most people. The return of demand for EVs is a very long cycle, guys, right? We're not talking about a package of gum here or about, the price of 2 different bottles of orange juice and I pick that one because I have less money, right? We're talking about purchases for a lot of consumers that are extremely expensive purchases. Sometimes one of the biggest purchases other than a house, right, is your car. And for this demand to come back, not only for EVs, but for autos worldwide, we saw in yesterday's CPI report, you saw that the new auto sales as a whole completely plummet, right? It's not only Tesla, it's not EVs as a whole, it's the car market as a whole, guys. Used cars have been going down, new car prices, the markups have been coming down as well. So it's just a very, very cyclical business. And Tesla, their number one product, selling a car, I understand that they do more. They're not just a car company. I share that view as well. However, for now, because of how much the car business is affecting their sales and affecting their demand, well, suffice to say that when 80-90% of their business is a car manufacturing business, well, unfortunately, they also benefit from the negative drawdowns that car businesses have. And this is just the same, guys. It's going to be quite a long time, in my opinion, before Tesla recaptures a lot of its growth back and margins back, probably mid-2025. Now, can the share price recover before then? Sure. But in terms of having quarter-over-quarter growth, quarter-over-quarter margin expansion, those consecutive quarters most likely only coming 2025. That being said, guys, the short-term outlook is just not that good. And you can see in terms of the technicals also, bears in full control. They control the weekly time frame, they control the monthly time frame as well, and they also control the daily time frame now again too. So your bears are in full control. That being said, we're approaching a key last level of resistance here, 167, and then it's all the way down, unfortunately, to about $150 for the line in the sand level of this sweet spot. And then, guys, we really start falling into some lower prices. For now, the bulls do have a very good chance of upholding the price here, about $150. I've always maintained for the past year, and keep in mind, I do analysis on this company every earnings. The fair value of their car business, guys, is roughly about $140. Anything else is bonus attributed to their AI, to robotics, to their solar business, to their services business, right? But the pure form value of only their car business, in my humble opinion, is about $140. So we're getting quite close to terminal fair value here, in my opinion, for that business. That being said, I would highly be interested in picking up a few shares if we come down to 150. Until that time, guys, the momentum to the downside, the sentiment to the downside is quite negative right now. Could it be a very good buying opportunity? As Warren Buffett always says, right? People say this all the time: be fearful when others are greedy, be greedy when others are fearful. Well, the timing of that tends to be different, right? It's different for everybody, right? You could, when everybody was fearful about Tesla back last August, right? You could have potentially had a very good trade as well. Could this time be a very good trade to be buying the dip in terms of be greedy while others are fearful? Yes, but the underlying factors, guys, that are affecting this business are not short-term things. So we may get a little bit of a bounce, but I would not be surprised, guys, if Tesla just hovers around these lower levels. Could we maybe make it back up to 200? Yes. But are we going to $250, $300 over the course of this year? I really don't think so. I think this price will be stuck largely between about $210 and $150 for a majority of the year until the company comes out with better company-specific news. So all that being said, guys, daily bears, full control. Daily downtrend continues at this point. We're going to be watching for the lower end of this trend line right here, $165. And the next target, as I said, guys, is down to about $152, $150. Full bear control currently. Right, we're still looking for the eventual recapture of the daily uptrend, not present. Weekly bears in full control, expecting downside continuation as well. So not the best news for Tesla right now. I'm keeping it on the back burner, but EVs, cars as a whole, guys, just not the best immediate swing trade in my opinion. Still a lot of time to be acquiring shares. There's no immediate urgency to be buying shares in my opinion, because there's no immediate catalyst for a snap of the finger turnaround. So that is the whole moral of the story. Is it a good buy at these levels? Yes. But is it an urgent buy? No. Now moving on to Palantir. Palantir, sorry about the long form on Tesla, but it just needs to be said, right? When it's the worst performer on the S&P 500. Now moving on to Palantir. So Palantir coming down a little bit, even though we had an Alex Karp CEO, the CEO of the company, interviewed today. Fairly spicy interview, as a matter of fact. We're not going to go over the details. You guys can do that on your own, but it was a fairly good interview as a whole. Didn't really give any more guidance to the company, just explained more what the company does. Talks about the workshops, the boot camps that he does, rather. In that case, guys, as well, Palantir shares currently still in a nice daily uptrend. Keep an eye, line in the sand level, 2350 to the downside. If we lose this level here, guys, could set up for the daily downtrend. At that point, would just be for very healthy weekly consolidation. I'm looking for a weekly higher low, anything above 2240, weekly higher low for potential recapture of the weekly uptrend right here, and sending it to $27.50, $28 top end of the resistance band. So bulls still somewhat in control right now. They've taken back a lot of the move. So if we do see lower high into lower low, just know that your weekly bulls are in full control. Tons of space still, anything above 2231. You guys know me. I'm looking to play Palantir. If we can come back down to 22, I'm looking to play at 21, $20 for a little bit of a swing trade. Now moving on to PayPal. Lastly, PayPal, 4% to the upside. PayPal finally breaking out and starting to really break above this downtrending channel line that we've been focused on for so long. Now you got it. So two things happened today. Daily uptrend is now healthily back in motion. We never really lost it, right? Never really lost it. The bears pulled back a lot, but we didn't lose these lows. Now, daily uptrend and cracking above currently the downtrending channel line. So now we have a few upside resistance targets, guys. Number one is obviously going to be this level right here. The previous shock the world highs, right? About $65. Past that, we're going all the way up to about $72, $75, this whole range right here. So the price appreciation for PayPal could be quite good. That being said, one day of breakout is not enough. We saw that back here. What we want to see is an extended breakout, retest of the channel line, potentially retesting 61 for breakout retest, and then run. Once we get that retest here, could be a decent opportunity for a swing trade, $60, $61. At that point, guys, you're looking for the swing trade breakout. The stop loss would go around $57, loss of that low, and your take profit at this point could be all the way as high as about $75. So PayPal looking fairly good for a swing trade right now, if I do say so myself. But just remember, one day is not enough. That's why we're looking for the bulls to prove it to us, come back, sit on 61, then might be a little bit of a swing trade opportunity. And if we're wrong, guys, That's why the stop loss is right here. It would just be a look above, fail, break down below, and then not looking good, guys, as well. So that's why we have those rules set in place. Could be a decent swing trade opportunity for PayPal, and the valuation of the company is still good. So all that taken out of the way, guys, I hope you appreciated today's video. Put a bit of work into this one, right? Obviously for the Tesla breakdown. Sorry we couldn't do Lennar earnings. Maybe we'll do them at a later portion of the week. I definitely have to run right now, so I hope you appreciated the video. If you did, drop a like on the video. We really appreciate it, guys. Helps me out greatly for the algorithm, get new members to the channel as well. And thank you so much to all of you who have taken the time to subscribe to the channel as well. We're quickly approaching our 900 and then 1,000 subscriber milestone, guys. It's been a beautiful journey ever since starting the channel last April. I love each and every one of you, and I hope you guys appreciate the content and also the transparency in my trades. Hopefully it's helped you guys out a lot in your investment decisions or trading as a whole. And if it didn't, well, hopefully it provides you entertainment value nonetheless. And as usual, guys, if you have any questions whatsoever, please leave them down below in the comments and I'll be happy to answer anything you want. If you want me to look at a specific stock, technical analysis on something, an options trade you might be thinking about, anything you guys want down below in the comments, and I usually answer within the first 24 hours. So take care, guys. Have a great day of trading tomorrow. I'll see you after the close tomorrow. Peace.